All right. So, really excited today for my special guest, Krista Morgan from Stage Fund. I've known her for the last few years. She was part of our Fund Accelerator community, and just excited to have her come back and talk about everything private equity, how to launch a fund, how to get into the venture space, how to interact with LPs, how to interact and co-invest with other GPs, top level market trends. I think there's a lot to really go through. So Krista, again, thank you for coming today, and so happy to see you. I remembered meeting you in person at one of those emerging manager events. So I was happy to do that, but also just really happy to get some more one-on-one time with you and do some storytelling with the community.
Awesome. I'm very happy to be here. Yeah, we met in New York, I think,
Hmm.
ages
Yeah,
ago
I think you
now.
came out here.
Yeah. Yeah.
So let's start from the beginning. So let's talk about. Let me hear your whole life story now. Let's talk
Great.
about where you. Well, I mean, let's kind of do that. Let's tell me kind of like where you grew up, maybe what you studied early in your career, and then what made you. Because you do have a unique strategy, which I think is very innovative. So tell me everything. Tell me about kind of where you grew up, what you started studying, maybe what you initially thought you wanted to do as a profession. If that was already private equity, that's great. It wasn't for me. And just tell me kind of how you got to where you are now, and then we can go deeper on kind of strategy and markets and all that.
Sure. I'll try to I'll give you the short version. Yeah, I mean, look, I guess firstly, no, if you had told me that I was going to end up as a general partner of a private equity firm, I would have said, I don't even know what private equity is probably
Hmm.
what I would have
Yeah.
told you. So I grew up really in Montreal. So I'm Canadian, grew up in Montreal. I studied economics and political science. And then I went after graduation, I actually moved to London with my husband. He did his master's in London. I worked in advertising and marketing, which was a lot of fun. Nothing like living in London in your 20s with an expense account. So
Oh
and big
yeah.
global brands as clients. So and then I had the bright idea to start a crowdfunding company. So I
Hmm.
quit my job. I moved to Denver to start a company with my dad, and I
Wow.
built a fintech platform. I did that for about 9 years. We grew the company. We loaned out over $1 billion. It was all going really well until it didn't, and we ended up with a really big fraud in the portfolio. And I had to go from I'm running a startup to I'm shutting down a startup and having
Yeah.
soft landed and like turnaround and all that stuff. It
Hmm.
was honestly overnight. Like I think a lot of founders,
Yeah.
like their decline is a little slower. In some ways, I think I was lucky that there's no time. Because the fraud happened and we still had a loan portfolio. So we had to wind it down. You had to keep it running while you're winding down, dealing with all your lenders. I had, 150 angel investors on my cap table. Like it was a real trial by fire.
Yeah.
And I met my partner Dan during that time. He's the original founder of Stage, and that was how
Hmm.
we got together. And that was at the end of it all. I was trying to figure out what I was going to do, and I talked to him about Stage, and he had this thesis and had been doing deal by deal, but had never started a fund, had never formalized it, and I thought this seems like I could help, and I joined him, and we launched our first fund, and now we're just finishing our last investment out of our second fund. And that was in 2020, so it's been kind of a roller coaster the last
Hmm.
4 years.
Yeah. Just backing up a bit, tell me a little bit
Yeah.
about your dad. So was he, it's amazing that you're able to build something with your dad. So did he come from an entrepreneurial background, a fintech background?
No, funny enough, so neither of us really came from fintech at all. Neither of us had a finance background. We're
Hmm.
both really, I would say, like sales, marketing, relationship
Yeah.
people. And look, it was a lot of up and down. Like truthfully, we had some hard times like running our business, and when it
Yeah.
ended, it definitely caused some strain in our relationship. But
Hmm.
I can tell you today, we're on very good terms, and we're able to like sort of talk through the ups and downs. And I don't regret a minute of having done it. but I would certainly caution people that it's nothing to,
Yeah.
start a business with family.
Oh yeah, I can imagine. I mean,
Yeah.
just family, friends. I mean, it definitely makes Thanksgiving much more difficult.
It,
And well, I
it
mean, if you live near them, it's tough too. But yeah, I mean,
yeah.
definitely. I mean, there's pros and cons. I mean, look, that's essentially what family offices are, right? They're
Yeah.
family businesses. There's a lot of drama, when there's succession planning. But
Yeah.
essentially, some of the most successful brands out there are families, right? You think about Walmart, you think about like Heinz. I mean, they're all family businesses that essentially built an investment platform within their family. So there's definitely pros if there's success and synergy and also learnings in your case. So look, I mean, all these that's just part of life, right? Just kind of enjoying the struggle, and then also just kind of learning from it and then growing and evolving, right? And that's exactly what you did.
Yes, yes. There's no question I learned the most
Hmm.
when my company failed. And I was forced to really, like, you have to ask yourself a lot of hard questions. And I don't, again, like I'm glad I wouldn't be sitting where I am today if I hadn't gone through it.
Hmm.
And I love what I do today. Like I can honestly say, like, I hope, knock on wood, that this is what I'm doing for, the whole rest of my career.
Yeah.
Um, so, you can't complain of, it's hard to feel bad about what happened,
Hmm.
because it just brought me here. Which,
Yeah.
yeah.
Absolutely. So, tell me how you kind of came up with the concept of stage fund. It sounds like you started kind of deal by deal, and it'd be good also to kind of unpack your strategy, right? Because I mean,
Yeah.
I have a lot of private equity investors that come on this program and also VCs, but you have a very unique strategy that I think was kind of the birth of like some things that you dealt with in the past, right? And there's also a unique opportunity that usually is not taken advantage of, right? So I think that's kind of a great selling point when you're thinking about like differentiation.
Yeah, I agreed. It helps and doesn't. When you're doing something different, everyone wants to know why no one else is doing it,
Hmm.
and why it hasn't taken off. But so broadly, I guess strategy in a nutshell is, we sit a little bit between private equity and venture. So we are doing acquisitions of companies called post Series A venture backed companies that, for whatever reason, are not going to get their Series B, right? You look at the data, 2% of seed funded venture companies become unicorns and kind of go all the way. And at every stage, you've got all this drop off that's happening. But you have, if you look at the last, 5 years, let's call it last 2 years accepted, but, prior, you've got seed and Series A companies that have raised like 40, $50 million. And so when we look at the market, we're like, that 40, $50 million has largely gone into R&D, right? It's gone into building a technology that we think often has a lot of value. It's just not going to be venture scale for whatever reason,
Hmm.
right? Or
Yeah.
maybe it can be, but it needs more time. It
Hmm.
needs a different go-to-market strategy. And so the thesis is, these companies, these subscale tech companies, once they lose their venture funding, it's like, what happens to them? And a lot of time, they've sort of just been fading away, or they turn into, what they call the zombie companies.
Hmm.
And we believe that you can have a really good buy, right? It's a value strategy. So we can buy because there are so few buyers. There's so few, and that for an incremental investment, not call it an incremental, maybe 20% of what's already been invested, you can actually get the company growing in a more balanced growth and profitability way, and then transact it, right? But you've restructured the cap table, you've removed all the preference, you've re-upped the founders, you've just right-sized
Hmm.
everything so that
Yeah.
now a 30 or $40 million exit is meaningful for everybody
Hmm.
around the table. So that's the
Yeah.
core. The core of the strategy is that just because a company is not going to go all the way to venture doesn't mean it should not exist, doesn't
Oh
mean it
yeah.
doesn't have potential. And we take this private equity mindset, into an early stage technology company, which I will tell you, having been doing this for 4 years, is very difficult.
Mm-hmm.
And we've learned a lot and made adjustments, but it is also, it's a lot of fun, and it's a great problem because you're thinking about growth, product development, like you get that excitement that I think you get in venture, but
Mm-hmm.
also you're, teaching these founders about, real cash discipline, like financial discipline. And, I mean, I like numbers. And so it's nice to
Sure.
sit with them and, have sort of strategic conversations about how you build the business in a profitable way.
So can we walk through kind of a case study? So, what's kind of a typical company that you like to look at for a deal? So in terms of, it sounds like it's mainly software. So it's not like essential services or like education
Correct.
companies. So software, what's kind of the typical maybe annual revenue that you're looking for? And then I guess what are some characteristics of the cap table that make it a great target, I would say. And then also like the check size when because usually when you think about buyout, you're thinking, look, you're buying out the entire company. There's probably a larger AUM. So maybe you can walk me through that. That might be helpful as maybe a case
Sure.
study.
Yeah, let's talk. So I guess high level, I would say the core, let's call it economics of the thesis are we try to buy at 1 to 2 times enterprise
Mm-hmm.
value,
Yeah.
like 1 to 2 times revenue, enterprise value. And when I say enterprise value, what I mean is a lot of the time in a distressed deal, you're taking liability. So you might absorb $4 million of legacy debt,
Yeah.
and on a, call it $3 million revenue company, you're
Mm-hmm.
taking $1 million of AP, and maybe there's $1 million of cash going off the table. So like that. And then ideally we get the deal restructured, we get it growing again. And then if we can transact it, call it even 2 to 3 times revenue with
Mm-hmm.
some growth, that's a very good return for us.
Yeah. Got
So
it.
like that's kind of high level, and it's we do really manage how much cash is going out in this second fund.
Mm-hmm.
We're allocating about $3 to $6 million of investment per total investment per company, which includes the acquisition price.
Okay. So that means that like if you're doing around 6 million, so the revenue is about, these are healthy companies that are making around 3 million a year, something
I
like
would
that.
say 3 to 7 million is
Mm-hmm.
typically where we acquire. So one of the first companies that we bought back in 2020,
Mm-hmm.
retail tech-enabled services company. They had their revenue had been up the year before we acquired them at like 9 million. But as you can imagine, retail technology when COVID came in 2020, the revenue just plummeted because they couldn't
Yeah.
deploy into stores.
Sure.
And so they had 5 million, they had 14 million of invested capital and 5 million of debt.
Mm-hmm.
And so the debt, and they were running out of cash. So the
Yeah.
debt is looking at this going, how are we going to get recovery? The revenue had slipped down to, I think, 5 million at the time, and they were losing $3 million a year. And
So were
so,
they defaulting, because it's a debt note, so were they
yeah,
defaulting on
correct.
just
They
kind of
were,
being able to pay? Yeah.
yeah. And most of our deal flow, so we actually really good, and it helps that I was a lender. So like a lot of our deal flow comes from lenders that we have
Yeah.
relationships with. Because,
Mm-hmm.
you look at venture lending has also skyrocketed right
Oh yeah.
alongside the venture.
Mm-hmm.
And so all these loans are effectively collateralized by, there's no real asset there. The
Oh yeah.
asset
There's
is the
nothing. Yeah.
platform that has to be running.
Mm-hmm.
So if you're a lender and in order to have any chance at recouping your debt, you have to have equity to keep that platform running.
Yeah.
So they really, everyone is hope. When you're in a distressed situation, everyone has hope. Everyone is
Mm-hmm.
hoping someone new check is going to come in.
Yeah.
But the lenders are the ones who are like, look, enough is enough. We got to get a deal done. So we often partner with
Mm-hmm.
them. But yeah, so in
And
this
then.
situation, there was 5 million of debt, and we
Mm-hmm.
worked with the lender and effectively did a restructure, right? So we said we paid them 1.25 million for the company. We left them with 1.5 million, I think, of senior debt on
Mm-hmm.
the go forward business. And then we gave them a $3 million, like preferred, effectively junior preferred
Yeah.
equity piece so that they could see their way to getting whole. They could have
Hmm.
some cash today. And then we added an incremental like $2.5 million into the company for operations.
Yeah.
And that company today, 3 years later, is doing, 16 million of revenue. They're
Wow.
profitable, they're growing, and we're working on transacting them. Now,
Yeah.
they don't all go that smoothly,
Sure.
it turns out.
But
But
I mean,
it's been great.
yeah, and I mean, as a typical PE mindset, you're also rolling up your sleeves and helping them, looking at their numbers, cutting costs, maybe changing management, to kind of get them to that point. And I mean, it's a great solution because the lenders, I mean, their other option is just to write it off as a loss and like, pretty
Agree.
much, and then the
Yeah.
company probably has to, essentially dissolve. So, I mean, you're kind of like bringing the company back to life, essentially.
Yeah, and we give the founders, we re-up the founders,
Hmm.
all of a sudden, the deal that's had the most, so like an acquisition we did, I think it was just about a year ago,
Hmm.
there was $55 million of preference sitting on their stack. The founder wasn't going to get anything at all. And now, as the transaction goes, right, he's sitting behind a preference stack of $10 million, and he's got 10% of the go forward company, and he's able to grow the business. And so that, like, the hardest thing, and having been a founder that has had to take the ego hit of your company, having to sit with your investors and say like, I really messed this up, and you're not going to get your money back.
Hmm.
That's the worst part, right?
Yeah.
If you can just get through and you just accept, like, look, everyone took a risk. Venture investing is high risk, high reward. And yeah, a lot of the times it doesn't work out. And so as a founder, if you can just kind of say, look, this is what it is, and I'm just going to manage to the best of my ability given the realities of my situation. On the other side of the transaction, like, you get a clean slate, you get a fresh
Hmm.
start. And
Yeah.
I think I would have given anything to be able to do that in my company, because you're usually, when it's happening, you're still excited, especially at that Series A stage. Founders
Hmm.
are still excited,
Yeah.
and that's actually one thing we've learned is our best acquisitions. So we've done 12 acquisitions in the last 4 years. So our best acquisitions are the ones where the founder has stayed and like decided to be a part of it, and that we could incentivize them, because that founder energy that they bring is really important.
And I would say, I mean, it's just very timely that you're mentioning this because I just posted something on LinkedIn. There was some guy that broke out like how the liquidation preferences could really
Yeah.
kill the founder. Like I literally just saw that this morning and I shared it. I was like, hey, this is a pretty good like breakdown of the math. I'll try to
Yeah.
find it and ping it to this
I actually
episode. But
saw it. I think it's the FanDuel story. I saw
yeah.
it.
Yeah. So that was yeah. So maybe
Yeah.
everybody got the same thing,
Yeah.
but yeah. I mean, it was kind of cool to see the math broken out because until you really see the numbers,
I know.
a lot of founders, especially in this market, and even fund managers, are willing to just take in the capital. Because they just need the capital to grow. They want to give themselves their salary. So like, so you're able to, when you do this renegotiation, you're able to wipe out some of those prefs and kind of renegotiate. You can kind of like calm
Yeah.
down the lenders because you give them some cash immediately as part of the deal, right?
Yeah, most of our transactions, we don't tend to do stock deals. So they tend to be
Hmm.
asset deals. So
Yeah.
you're kind of effectively setting up a new entity and
Hmm.
saying, here, we now have a cap table. What do we want it to look like?
Hmm.
Which is
Yeah.
hard, a lot, because I have a conversation a lot when I'm structuring these deals with founders where they're like, well, what's the valuation? I'm like, we're no longer in the valuation game. Now
Yeah.
we're in the, like, to your point, the waterfall game.
Yeah.
Here's what the waterfall is going to look
Hmm.
like. Here's where you sit in it. Here's how much capital is going in. And then now, if we sell for this amount, here's how
Hmm.
much you get. Who cares what the valuation is?
Got it.
Doesn't matter, because to
Hmm.
your point, valuation is just a vanity metric.
Yeah.
It's not a real. It doesn't
Hmm.
mean anything because of the reality of
Yeah.
waterfalls.
Yeah, so I guess the lesson is, because it's really a debt structured deal, there really isn't like it's not like a priced round. It's essentially like a loan, essentially, right? We're going to
It
give you this
it's
money.
yeah, it's almost like saying we're like, what if we just had a new cap table,
Yeah.
right? So today, you own this is what your cap table looks like
Hmm.
tomorrow. This is your new cap table.
Yeah.
This is your new debt structure. This is your new preference structure.
Yeah.
And we do put a liquidation preference on our capital,
Yeah.
because we are distressed investors and we have to make
Hmm.
sure we protect like our core return.
Yeah.
But if you're putting in $3 million, you can sit with a 3x liquidation preference. You're still only on a $9 million preference stack, which for most venture-backed companies is a third of what they
Yeah.
were looking at before.
Is that what you recommend as a buyout investor? To
I
maybe go to 2 to 3 as like
I
kind of a
think,
standard
look,
because of the risk,
so
right?
it's the risk. Yeah, look, this is a risk reward, right? In
Yeah.
my
Hmm.
mind, and we've done all kinds of, the thing I actually really like about being in this, call it like distress value world, is you can get really creative with your deal structures, which my
Yeah.
lawyers hate. My lawyers are like, why don't your deals all look the same? But it's because, I'm sitting with investors, like the best deals are the ones where actually people still believe on the other side, right? That
Hmm.
on the seller side, they're like, I still believe in the upside, but I don't want to put in any more cash. I don't want to take calls anymore. I just want to sit back and see what happens. And so then you can be like, okay, so if we sell for this amount, this is our liquidation preference, this is our equity split. If we hit like if we sell for over 50 million, I'm going to have a secondary waterfall and I'm going to push, you're going to actually
Hmm.
get, I don't know, 40% of the proceeds for anything over 50 million if it does better. Like you can
Hmm.
get really creative, and you should see some. I like a good spreadsheet. I like a good waterfall spreadsheet. And so
Yeah.
we sit and but then and then I think that's the right conversation to be having
Hmm.
is, what will I get at these different sale prices, and is it worth it to me to do this transaction, and do I believe you? Right, that's
Yeah.
the thing. I think that, because I do talk to other managers that are like, I want to get in the distress space, and I think the hardest thing about being a distressed buyer is you need to have credibility, because
Yeah.
no one wants to sell you their company, let's call it like for like a for a set a sale price, if they don't believe you can make it work. So you
Hmm.
really have to be able to prove to them that you have the operating know-how to make these companies successful, that you will create like enterprise value
Yeah.
after the deal is closed.
And I mean, essentially, too, what's kind of what I'm trying to make sure I understand is, if you buy them out, obviously you own the assets, you own
Yeah.
the technology, but it's not an exit for the founders, right? You're essentially buying them out with an injection of capital, so they can just go back to work and make the company go
It,
back to life, essentially,
correct.
right? Because
It's
I mean,
it
sometimes
is
people might
a
think
it's a
buyout,
reset.
yeah, it's a reset. So it's but are there instances where it makes sense to just buy them out? I don't think so, right? I mean, because
I
it's
mean,
really,
look, I would say we don't really have the capital as I think
mhm,
about Fund Three. So I've started to work on Fund Three,
yeah,
and I have been thinking like, could we put more money to work? There are definitely deals that I see where if we could write a $4 million check up front, you could probably get a better quality asset.
hmm,
So how does that work? And I did, so we're closing an acquisition hopefully in the next week, the last one in Fund Two, where it's been a fully bootstrapped company. So there's really been no material investment. And in that
yeah,
one, we're giving the founders basically like $1 million note, like some cash up front, and then over 18 months we are going to actually pay them cash. It's the first time we're doing that, so
yeah.
we'll see how that goes. But
I would
it
say something that I've seen for larger single family offices that are more institutional. They just like to acquire these businesses because of the cash flow, and they just
yeah
kind of own all these different entities that are just cash making machines, and they're usually less sexy. They're like
yeah
like something that could be infrastructure or manufacturing or logistics that are just kind of durable, multi-decade businesses that have been around for a long time, and
yeah
they continue to grow. And then they don't really have to do a lot of the. I would say they probably don't have to do the strategic work that you do. But like one of my role models is like Sam Zell, right? So Sam Zell started in real estate and then kind of started getting into private equity. But like buying those assets. I think one thing that I've also seen, and like I heard this from his book, was the benefit with like asset heavy businesses is you can also sell some of those assets for liquidity. Do you see, that as an opportunity in the software space? Are there just things that you can sell off, because it's more like in the cloud, right? So isn't it, I don't know if there's anything that you can, unless it's like a division or like a business unit or something.
So the companies we're buying tend to be small, right? So they don't have a bunch of, but we actually
Yeah.
did this. We acquired a company that they had, I don't know, it was like 4 million of revenue, but they had this 20K a month revenue stream from, and it was just one they had like this little software feature, really.
Mm-hmm.
This one customer bought it. And so we went to the customer and said, I think they paid us like 350,000 and just took it
Mm-hmm.
out. Cause we're like, it's a distraction. Cause a lot of what
Yeah.
we're doing, cause look, to your point, it is actually pretty hard to make $3 or $4 million software companies profitable. That is not
Yeah.
nothing, because
Mm-hmm.
you still have a fair amount of R&D OpEx required. You still have a fair amount of sales OpEx, and even at an 80% gross margin, that's not like, given salaries today in tech, that is not a huge amount of gross dollars going into your OpEx line.
Mm-hmm.
So you have to get growth. It's hard to make them, but if you can, that's kind of what we're trying to say, is if we can figure out how to get them cash flowing, to your point, it does actually start to make them very valuable, because then someone can buy the tech and say, I'm going to hold it. I'm going to add it on to something else. Founders, I know that if you're trying to go down let's call it plan A, rocket ship, unicorn path, growth is everything.
Mm-hmm. Yeah.
But once you actually have, there is actually what we're seeing, especially in today, right? Today, the market for not huge, but stable technology companies that are not burning cash, there's a lot of demand for that, because people want
Yeah.
innovation. They
Mm-hmm.
want that technology, but they don't, they don't want to fund the cash burn, right? It's really hard. It's really hard as an investor to buy a business that doesn't make money.
Yeah. What I think
So
is interesting too, is these companies like Zoho Analytics. I think they're based in India, right? They're like
yeah,
a billion in
yeah,
revenue, but like they've taken no capital. But what they've done, I think, which is really interesting, is they pretty much wholesaled all of the tools of like all these other companies, and it's
yeah,
just like one cheap subscription. So I feel like that is going to be a continued innovation where it's like, look, why do I need Salesforce? Why do I need HubSpot when I can just pay for this one platform that does everything for a
yeah.
fraction of the price? And it's even more relevant during tough times when like everybody's trying to cut costs to improve the bottom line. So I just really appreciate like those kind of companies that are just developing healthy cash flow, and they're able to just really just provide a discount, compared to the market of like all the disparate systems that people have to use, for their workflow.
I I totally agree. Something we've done, so we've done 12 acquisitions in 4 years, but we have 5 platform companies. And
Mm-hmm.
so we've gotten very good as a firm at roll ups. And
Mm-hmm.
I think of them as like this like mini roll up strategy, right? Roll ups are very heavily used in bigger private equity.
Sure.
But actually, most people don't take a $3 million software company and combine it with another $3 million software company. That is very rare.
Mm-hmm.
But what we're seeing, I think, to your point, is like, if what you're trying to do is create stability and cash flow, and like then who the G&A, there's actually a lot of R&D, G&A, sales like cost that can be easily split, especially when the companies are smaller, across multiple but complementary product lines. And so we've seen and the organic growth, like the cost to take revenue from $3 million of ARR to $4 or $5 million a year is high, right? That's actually a really big sales
Mm-hmm.
cost investment to make that organic leap in growth. So if you can buy 3 million of ARR, and we're buying it at like 1 times revenue, maybe a third of that in cash, all of a sudden we went from 3 million to 6 million with $1 million investment, but it was a sure thing, right? It wasn't,
Mm-hmm.
oh, we hope this investment in sales will lead to organic growth.
Yeah.
So I think M&A, like, actually, I think there's so much distress happening in venture right now with the pullback in funding, that I think I think we're gonna start to see really interesting creative M&A happening at like a much smaller level than we've
Mm-hmm.
ever seen it before.
Yeah, and they got those platforms like Micro Acquire where you can like buy little
Yes.
mini
Yeah.
software businesses. What are your thoughts on that in terms of like the platforms as like a marketplace? I've used it a few times. I didn't really see anything that I was like that excited about, and like to in my opinion, some of the exits, some of the price points were like a little rich in my opinion. But I don't know what your thoughts
Yeah.
are.
Yeah, we
And some of the
don't.
businesses were like not really that proven. The revenue wasn't like that
Okay,
great.
great.
But like I don't know what your thoughts are in terms of like you know how marketplaces can innovate.
I mean, I haven't, to your point, I've taken a look at some of them and I haven't seen it. And no, and I would say too, the venture backed businesses don't go on there. So a lot of our
Hmm.
thesis is that we're willing to buy these companies because we're saying this is the money that's been invested. We think there's value in that capital. Whereas like
Hmm.
buying a bootstrap business, if it's still really tiny, there hasn't been that much money in there. So in our minds, it's probably more easily replicable. Like there probably isn't technology that's actually that useful. So you'd really have to
Yeah,
believe in the revenue and the customers. And if that's good, then to your point, you're going to overpay. I mean, we're
yeah,
just, and we're, I like to buy things on sale. What can I say? I
yeah.
do
Nothing wrong with that.
that.
Same
I
here.
tech companies close, you know.
I'm the same way. Yeah, I mean I
Yeah.
totally agree. So I'm trying to like in my mind think of like the different areas for kind of upside with this model because I'm thinking, look, you've got the liquidation preference, which
Yeah.
definitely protects you. There's interest, right, that that you get from obviously injecting the cash. There's
Yeah.
obviously the upside from the exit, right, and then I guess you appreciate the revenue growth. Like, can you in some structures like get some dividends on the revenue at all, or is that too predatory?
We no, well, so here's the thing. We are control investors. So once a
Yeah.
deal closes, the answer is we can do as GPs
Hmm.
whatever we want within
Yeah.
reason, whatever we want within
Sure.
reason. We try to not be total jerks about it because
So
then
you're
no one
looking
wants to
at like
work
yeah.
with
So
us.
another differentiator. You're looking at like maybe 75 to 80% ownership or more in the
Exactly,
company. Got
exactly.
it.
That is exactly
Yeah.
that's when I talk to LPs. So when I get LPs that are like, Krista, no one else is doing this. If this is they call it people, we get what we call the like broken toy argument, right? Which is the venture guys didn't want this company. It must be bad. Why would you buy it? Like, why would you
Hmm.
buy this broken thing?
Yeah.
And what I'm saying is, it is bad for venture because venture has a very specific way that they get return, right? For them, for their like economics to make sense, they need the company to exit at this whatever the
Hmm.
much larger number is.
Yeah.
When I underwrite a deal, the first thing I'm really doing is saying, okay, if I sell this for 20 million, will I get 3 times my money?
Yeah.
And that, like, a lot of my structuring is, so I'm coming into, if I have a 3x liquidation preference, participating liquidation preference, and I own 80% of it, then yeah, my downside is protect. I can usually sell that company for like 15, 10, 15, $20 million and do okay.
Hmm.
Right. And there is risk here. It might be
Yeah.
broken beyond repair. We have bought things. Trust me, all 12 companies we bought, they were not all good. Some of them we were
Sure.
like, we buy it and then we're like, oh, turns out we had a thesis that this would grow and our thesis is wrong. So we
Yeah.
have to try to fix it. So you need that to be able to offset the risk
Hmm.
that you're taking.
Sure. So tell me, okay, so last couple of years since we met, tell me all
Yeah.
that you've learned so far. As
Okay.
a private as a fund manager building a firm, what are some of the biggest learnings that we can give to the audience here of like emerging
Yeah.
fund managers?
So I just before this was writing a letter to one of our LPs who was basically, he was sort of like, look, Krista, like, I think here's where you guys have done well here. Like, he's like, I think you're great at buying. I think you guys
Hmm.
get really good deals. You find interesting assets and you're really good at buying. And he was like, he was sort of saying, what I don't love, he's like, I don't necessarily agree with all of your, call it like operating, like, the way you guys are operating these businesses. Like, we don't necessarily agree with it. And he said, he was kind of saying like, I don't think this roll up, this way that you just like fix things by buying something else and adding to it, because that is a lot of how we fix it. He's like, I don't agree with that. And my point to him is, understood. I understand you don't agree with it, but like what we have learned about ourselves, and I think we're a small emerging fund manager, which means we have a small team, which means we really have to figure out where we cannot be good at everything. We have to figure out what we're really good at. And it turns out we've built over the last 4 years an operational machine. Like we make like we can acquire companies. The fastest we've done is 12 days, but in 12 days, acquire a company. And that means that we can actually, it helps us get better deals. The reason I'm good at getting good deals is because we say to people like, you're running out of cash, trust us, we can get this done. And so, and I guess what I'm saying is we kind of operate and build the strategy based on what we are good at and where we can get leverage. For us, we've become excellent at M&A, like call it the transaction execution.
Yeah.
And, so that's something we've learned about ourselves. We've learned that this is a very high touch models. As I think about future funds, I have to make sure I build the fee structure. Like I have to make sure, cause like this is actually a hard, people don't appreciate this. This is a hard business to make money when like your top line's kind of fixed and like yet you have to like, if something's going wrong, like you have to get in there and fix it. So I think figuring out the business model and how we have to structure going forward. And I have learned, I guess I've got all kinds of little lessons on structuring.
So I would say so I'd say the summary of that one is, helping educate people on like your strategy and why it's been repeatable. I think that definitely helps. I don't know, does that make sense? It's kind of like a high level learning. Yeah. So I think a lot of times like the education before allocating, and then also like while being in the allocation process, kind of getting updates. I think continuous education, kind of helping them understand the strategy, why it's been repeatable, and you have all the data too. So I think that definitely helps. What else you got?
Founders, we talked about that earlier, right? When we first came into this, we were like, oh, it doesn't matter if the founders don't stay, we'll just bring in our own teams. Turns out actually we now look at deals where we think the founder will stay, and we change our perspective on the deal if we know that they're not going to. So that's been something that we've learned. And I don't know, I've got like a lot of little things in terms of the concessions. I think you really do have to think about what deal concessions you make at the beginning, because in that moment when you're trying to get a deal done, it's so easy to say, oh, it's fine, we'll just like give on price, or we'll just give in. And actually when we hold, and now like I'm so much, that buy, what I pay up front and what I agree to up front is everything. It's like and so now the number of times that I just walk from deals and say, look, we're now at take it or leave it stage, and not getting emotionally attached to the deal.
Yeah, sure.
That's been and that's just something I think the more you get into it, that's really paid off.
I think that's relevant in venture too, because, some of these deals, these overhyped deals are oversubscribed. So there's multiple investors that have different term sheets. So like maybe you give in to try to win the deal, where like I feel like in your situation, I feel like sometimes there's a little more leverage that benefits you too, because these are deals that you've kind of sourced and screened on your own. You've kind of privately curated them through your relationships. So maybe your edge also is that maybe these deals they're not going to demo days, right? And they're not like at YC demo days. They're deals that you have to kind of really pick and choose and pull under a rock and do a lot of diligence up front on, to like see if it fits your criteria. So there's probably not like 5 other buyers lined up, but you're kind of like, look, these are the terms. And look, look at my track record. Here's the deals that I've done. I've done this repeatably over and over again. So I think that goes back to your reputation point.
I agree. I think it definitely is different in a distressed situation. We can say like, if we're the only buyer at the table, then no, but they often do. Here's the thing, right? They have other options. They cannot do a deal at all. They can decide to wind it down.
Yeah.
And sometimes, and it has happened that the investors on the other side will say, well, if Stage is going to get a really good deal, we'll just give you another bridge round or whatever for some. So that happens too. But I think
Yeah.
I think if you're going to be the person that's negotiating deals, and I think just like really understanding your fund economics, what you need to make it work and not deviating from that. Cause it is easy in the heat of a deal to be like, oh, to your point, I'm really excited to get in this deal. I'm going to just give on this.
Yeah.
What we find is in the down, it doesn't matter if everything goes well. If you compromise and everything goes great, it doesn't matter.
Yeah.
But the number of times that things don't go well, it's for like really sort of understanding that down case and structuring to protect that down case and not giving on that, I think is really important.
Yeah. So I'm thinking, if I were to summarize that one, I think it's, being very systematic in your criteria and like maybe establishing that first, like, hey, you know what, in my mind, I know I'm not going to go above these terms. I know I have to at least get, 2 to 3x liquidation preference. So like kind of like already architecting that in your mind and like knowing that like those are hard rules. But to your point, like all of us fall in love with founders. We fall in love with like the vision, and we also like want to help them, right? Like humans naturally want to kind of like, be empathetic and be like, look, I really know that I can help him or her. So like, I think in that point, the emotions kind of start pulling you away from like your stringent kind of criteria process. And then, what advice would you have for emerging managers building an LP community? Maybe what are some learnings when you're kind of, I guess, like building the pipeline? And then obviously there are so many different funds that focus on different sectors. So they do have challenges too in terms of executing or getting the people over the finish line to help them say, wow, we're going to take a chance on you. So what's kind of worked in terms of, number one, building the pipeline, finding people that could be relevant. And then number two, kind of convincing them to kind of eventually come on.
So what worked really well for us, the way we got the first fund raised, was we found effectively a family office that Dan had a relationship with, and they basically seeded us, right? What they did is they provided the capital to let us warehouse our first like 2 investments. And then we were managing those investments as we were fundraising. What we found is LPs, especially at the beginning, and I'm sure you get this all the time, right? Everyone's nervous about blind pool. So everyone wants to see if you can actually buy. So spending our time just figuring out, getting really creative about how do we just buy our first company and get that running. That helped us. Because then what happened is we were fundraising, and actually we got, let's say I was really good. Maybe I was a bit lucky, but let's say I was good. That company was actually performing. The performance was increasing. So as an LP I talked to 6 months ago, they could be like, oh, last time I looked at this company was not doing as well. Like clearly under your management, it's going better. So just whatever we could do to get proof points. And that was how we closed our first fund, and our second fund was the LPs got excited about what they felt like their investment was already protected by the asset we already had.
Yeah, sure.
And so
there was the confidence so it's almost like you kind of were like an outsourced fund kind of concepting a deal to prove that it like worked out, but it was still part of the fund structure. So it's still like an
so
LP
it got contributed in. We contributed in cost, even though theoretically, like when the fund closed, it was definitely worth more than what we had paid for it. But we just said,
sure,
this is what it is. Like we'll contribute.
That's the cost of doing business and converting.
Cost of done.
Do you think some people could possibly, let me ask you this because it's in my mind, could some people possibly kind of structure that as like an SPV and say, look, let me do this deal for you, and then they can kind of roll that in or roll that capital? I don't know how you would do it, but like, work with your securities attorney to kind of make it count towards the fund?
I think so. That's what so we basically just effectively, we had already set up our fund GP. So our GP was the owner. And then, we just like when the LPA finally signed, there was like contribution. It was basically a contribution. Like the GP,
it's kind of like a multi-series LLC that you can kind of have one asset that's like a series, but it still makes up the entire partnership or something like that.
Correct.
So
Correct.
I have a,
So that's
I have a
how.
securities attorney. If you want me to bring him in, he could probably share more details.
No, I spend
But
enough of my life with attorneys. I don't think we need to. But it's funny. You were asking before, what did I think I would do? I actually thought I was going to be a lawyer. When I was growing up, I was like, oh, I'll be a lawyer. And now that I work with lawyers all the time, I'm like, I am so glad I'm not a lawyer. Like,
yeah.
that is not the job for me.
Well, I mean, I'll
But
say this:
yeah,
some of the
and
tops. Oh, I was going to say this to compliment you. Some of the
yeah,
top PE investors were lawyers, right? Sam Zell, David
yeah,
Rubenstein, and they're
yeah.
like, "Look, I don't want to be a lawyer. I'd rather be an investor." So, so
Yeah,
I think you're
it
on the same
helps to
path.
know. It helps to know. Yeah, I could definitely play a lawyer on TV.
Yeah.
I could do that, but I without being one. Um, I had something else I was going to say. It's communication. That is something we learned. Like, and I think we got lucky in that we had some LPs that were kind of more sophisticated LPs that came in privately, so like personally into our first fund. So even we don't have really we don't have any large institutional in the funds yet. We're working on that for Fund Three,
Hmm.
but they really pushed me on communications. So I would say, like, if you look over the last 18 months, like every quarter a report, even when they don't all look good, right? Like
Yeah.
every quarter report, we do annual reports. And actually, we were just in New York last week and we did our annual meeting. So we did a webinar. We invited all our LPs across the two funds. We talked about what was good and what was not good. So, and the transparency is definitely a double-edged sword, because I get emails like, Krista, like, you tell me everything and I don't agree with it. And I'm like, okay, but you know what? What I
Yeah.
know, having run a company with a lot of angel investors, is people would rather know. They might
Hmm.
hear things and not like them, and then
Yeah.
you have to like
Hmm.
address those concerns, but they want to know. And if
Yeah.
you are really diligent about your reporting as an early stage manager, because everyone knows, like, it's hard and I'm doing it on weekends, and it's
Hmm.
not my most fun thing, but it really matters, I think, to them
Yeah.
and to LPs that are going to diligence us going
Sure.
forward.
Yeah, and then I would say, I'm assuming, just warm referrals help. Are there any platforms, like what else has worked as far as kind of meeting new LPs? Has community events helped, webinars, content? Is that as relevant, or is it more just kind
It's
of,
been, I would say it's been networks, asking
hmm.
LPs, and our best so, and actually we've done well working with some of the syndicates. Like, I think
Hmm.
there's a lot of high net worth syndicates that are getting more organized and doing so.
Yeah.
Like our largest LP in Fund Two is effectively a syndicate of high net worth individuals,
Hmm.
and that's been great. The manager really shields us from from every single investor.
Yeah.
So we feel like we're dealing with more of an institutional LP, but
Hmm.
they were able to raise a lot because it was across 60 high net worth individuals.
Yeah. Well, this was amazing, Krista. I mean, I think we unpacked a lot. We pretty much
Yeah.
did like a entire financial modeling lecture.
I like
So thanks for all your
it.
time and thanks for unpacking all this. I think this is really helpful. I think it's a great sector to really understand. I think a lot of these companies are going to continue to evolve and probably be on your target list because of liquidity, because of
Yeah.
the investments pulling back. So I think there's going to be much more fund structure. So I think probably 6 months from now, you'll have some new exotic, strategies and structures that I think we can talk about, probably from our peers as well. So I think it's really cool to see people like you innovating and like in kind of like the investment strategies that you've been doing, and it sounds like you're doing really well. So
Well, thank
glad I
you.
got to catch up with you and learn from you all this time.
Likewise, this is great. I really appreciate
Yeah,
it.
thank you. Well, have a good day, and we'll catch up soon.
Okay. Thank you.
All right.